For years, if you wanted a guaranteed win in the American real estate market, you looked south. Austin, Texas was the undisputed crown jewel of the Sunbelt boom, a city where growth was relentless and the return seemed mathematically impossible to lose. Listen to the local real estate industry today, and you will hear a very familiar, upbeat story. Market advisors claim that confidence is building, and brokers insist that buyers are acting with urgency because homes remain a, quote, good investment. That optimism suggests a return to normalcy, but the underlying data shows a divergence that most investors are currently failing to account for. This chart shows the metro-wide pricing trends over the last year. As of April 2026, the median sales price in Austin is $440,000. That is down 1.9% year over year. But while a price dip catches headlines, it is actually a distraction. Losing equity is a concern, but the systemic danger to an investor's portfolio comes from the staggering volume of homes that simply aren't selling. This graph shows active listings across the metro, and it reveals a massive surge of inventory weighing down the market. Right now, there are 11,592 active listings flooding Austin. That sheer volume of unsold homes stands in direct opposition to the claims that buyers are moving with urgency. Beneath the rosy industry facade, Austin is suffering a silent, expanding liquidity crisis. Everyday investors are purchasing properties expecting a quick turnaround, only to find themselves stuck with assets they cannot offload. To understand the magnitude of this oversupply, we have to look at the metro-wide absorption rate. At the current pace of sales, it would take 4.7 months to clear the housing inventory currently sitting on the market. This heat map reveals extreme stagnation. Bastrop County has a bloated 7.3 months of inventory. At the neighborhood level, zip code 78742 clears in just 5 days. However, 78675 is stagnant, sitting unsold for 320 days. Treating Austin as uniform is a high-risk gamble. This stagnation introduces a financial mechanism that turns a slow market into a trap: carrying costs. These are the recurring expenses required simply to maintain ownership of an empty property. Sitting idle for 320 days, a house transforms into a cash-draining liability. Every unsold month, you bleed capital covering property taxes, insurance, and HOA dues. Borrowing costs multiply this bleed, with cumulative interest over 11 months quickly eroding any projected profit. The optimistic industry claims about good investments often ignore this time-based destruction of wealth. In an illiquid market, time is the ultimate enemy of yield. The longer you wait to close a sale, the more your potential profits are erased by the cost of simply holding the asset. While industry insiders point to a shift in buyer psychology, the data suggests something more structural. Buyers are hitting an absolute ceiling on affordability, creating a ceiling on market momentum. Expanding the housing supply is a massive win for families seeking accessible homeownership. But for the individual investor, that same influx of inventory dilutes your leverage and pricing power. Austin has definitively transitioned from a speculative boomtown into a mature, localized, and highly competitive market. Broad regional investing is over. Generating a return in this new environment requires hypercritical, surgical asset selection based on micro-market data. Sophisticated buyers must now stress test their portfolios for localized illiquidity and factor in long-term carrying costs before committing capital. Purchasing in the Austin market today without a mathematical plan for your exit strategy risks leaving you with a cash-draining asset that you cannot offload.